Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Cliff Corso, Chief Investment Officer with Advisors Asset Management. We're going to discuss the three key questions the market faces in the next 6 to 12 months. Cliff, it's great to have you with us. Welcome to Trade Talks.
Well, thanks for having me, Jill. I appreciate it.
Before we get into that, let's review the key themes from the first half of the year, because it kind of was a Goldilocks scenario in some respects.
Yeah, and I think that's a good term for it, Jill, as a historic confluence of three major events that really propelled not only the economy, but continue to propel the markets. And those are, we might call them the three Fs. We've got historic fiscal stimulus with potentially more on the way. In the last 7 months alone, there was $3 trillion of fiscal stimulus put into pockets and spent. That number in and of itself is about 15% of GDP. We also have a continually accommodative Fed, notwithstanding a little bit of a tilt toward perhaps tapering a little bit sooner and tightening a little sooner than a couple months back, but still very accommodative Fed policy. And the third is the increasing freedom of moving around the economy as the economy continues to reopen and benefit from the vaccines. So we've had quite a run. 2019 was a 30% plus equity return. 2020 was 18%. We thought for 2021 it would be somewhere around 8 to 10%. And we know now that we've actually already exceeded that. So clearly a lot of positive, and the markets reflect that.
So what are the three key questions the market needs to ask itself, and when we look at a little bit longer term, say 6 to 12 months?
Sure. So the market's been very, very patient, notwithstanding that we're heading into peak inflation, which will begin to come down the other end of that slope due to the transitory base effects. However, that coming down that slope doesn't necessarily mean we're going to come down to that 2%, 2.25% that the Fed is looking to run, allow the economy to run, inflation run a little bit hotter on. We think it'll be a little stickier than that, and we might be hovering closer to 3% for quite a while, perhaps quarters. And that might test the market's patience a little bit. The other is the question around the Fed itself in terms of the tapering component of it. So if inflation is coming down, but running a little bit hotter than this 2.25 that the Fed hadn't said specifically, but guiding us toward running a little bit higher than 2%. Now, does that portend perhaps pulling forward tapering conversations in the market, and indeed maybe even pulling forward tightening? I just saw in the last Fed meeting where the so-called dots, which are the Fed's projections of how they might raise rates, moved up a little bit for 2023. So we think tapering, the transitory conversation around inflation, are two of the three big ones. And then the third would be taxes. Obviously, we're seeing at this point a debate around spending for infrastructure. We'll see as that debate continues to occur how this will all be paid for, and perhaps the debate over taxes not yet embedded within some of the prices within the market.
So Cliff, should we get a taper tantrum? Do you think that could be a short-term pop in volatility? Could it be a longer-term event? The Fed is pretty clear about telegraphing its message. I don't see why the market would find it so surprising.
Yeah, no, and the market is been so reliant on negative real yields, meaning the Fed's action has created a situation where the nominal yields are very low, but when we look at those yields compared to inflation, borrowing costs are actually negative for higher quality government paper. And so an example of that would be the 10-year Treasury today, trading somewhere around 1.45%. Yet we just had an inflation number that was 5%. And again, expecting that to come down to the 3% upper 2 level, that's still a negative, more than a negative 1% real yield. And it's really not so much in our minds that the Fed will move, and the market is a little bit schizophrenic on this. On one hand, doesn't want the Fed to move too quickly. On the other hand, doesn't want the Fed to fall behind the inflation curve. And so I think it's just that increasing uncertainty that might test the market's patience. But we're not calling for, using the Goldilocks metaphor, we're not calling for the three bears to come out. We think it'll be a muted volatility because there's some pretty powerful forces still propelling positive and an optimistic outlook for markets.
And Cliff, with that backdrop in the last minute here, when you think about portfolio positioning, what does it favor at this point?
Sure. So we think markets, as I said earlier, are fulsomely priced. We think it portends creating a little bit more conservatism in your equity portfolio. One way to do that is by focusing on dividends. If we have a growing economy, growing earnings, we should have growing dividends, and that income can act as a little bit of a stabilizer. For bonds, underweighting duration seems to be a pretty clear path. However, we would say the same for the bond market. Overweight income within the bond market. Income has been the dominant source of return in fixed income throughout the years, and we still think that that is the place to be. Focus on income and underweight duration.
All right, Cliff, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
My pleasure. Thanks.